Hello and welcome to this edition of Closing Trades from the ET Now Motilal Oswal studios. And the volatility in the market continues. While right now you may be just a smidge in the red, but that was definitely not the whole story, because look at those jagged edges on your screen that we had throughout today's trading session. Now, of course, on our way to recovery, but let's see whether it sustains through the last 1 hour of trade or not. But that said, what's under pressure today? Once again, BEL. PSCs are having it rough today. So not just the large caps like a BEL, but look at what's happening with an NBCC, for instance. That's cracked a good 5% in trade. There's HAL, which is currently down 4% in trade. Look at NBCC, 78 bucks is where that stock is. Hindustan Aeronautics, 33.29 on that stock. There's BHEL, which is cracking very hard. Another 5% of a loss coming in there as well. So some of these PSUs, irrespective of the kind of selling that you've seen in the PSE index, these stocks seem like there's more selling to go and more pain ahead for them. What's aiding the recovery? Reliance Industries. Look at that intraday graph, because that's pretty much in sync with what's happening in the index right now. It's pulling up the index along with its weight. Axis Bank holding out well. There's Maruti, which is now breaking into the green. Bajaj Finance, HDFC Bank, a smidge in the green right now as we speak right now. And select IT names are not looking bad. So Wipro, for instance, is one of the top movers on the index today. TechM is holding out 1.6% in trade. Infosys as well pulling up its weight, holding marginally in the green as we speak right now. And other than that, there's Kotak Bank as well, which is not looking all that bad. But are we out of the woods? What's the market texture looking like? Let's welcome on board our experts and figure out exactly that. We've got Devain Choksi on the fundamentals, Kunal Bothra and Naresh Mirani joining in on the technicals. But Kunal, let me start off the discussion with you first. What's the market texture telling you? Because as we're approaching closer to the expiry, the intraday volatility is getting pretty high.
Yeah, it's getting pretty high, but now I think it's still getting restrained towards maybe the first 1 hour of the market move. Now, yes, the mid caps and the small caps today also, I think start to see a sharp correction. We saw almost like a 250, 300 point kind of a sharp correction on the Bank Nifty from the opening highs, and then similar was the case in terms of percentage for the Nifty. But there's one thing which is coming out as a very strong support or a floor point for the index, and that's the 22,800 mark. So today's low on the spot level for the Nifty was almost at 22,800, 801 on the spot Nifty. So this is the fourth attempt for the index, and in the previous three attempts we were discussing earlier also that the markets have seen decent bit of bounce back. So we can just expect that maybe 2200 mark is now acting as a major pivot point or a zone where the index is finding strong bottom for itself. And if we manage to see a bounce back led by large cap names, then I think this time around also the bounce back could be at least 250 to 500 points also.
Right, so that's what you need to watch out for when you talk about the benchmark indices. With Kunal, I would like to draw your attention to the Nifty Auto Index. 7th consecutive day of decline coming in for the auto index. It is in fact set for the worst run since late February 2022. Below is all key DMAs, is it?
Yeah, below it's all key DMS.
So what's the outlook here? Because if you look at the data that's indicating, except Maruti, all the other auto index counters, all the other stocks in the auto index is down on a YTD basis.
Yeah, it's down, and I think today is one of the reasons why auto index is down is because M&M has started to crack. I think that for the first time, I think the last many days, we've seen M&M.
Even yesterday it was under pressure actually.
Yeah, but the stock today has fallen below the 200 DMS, so that's a more critical break of a support for M&M. But we did a ratio analysis on the auto stocks or the auto index with respect to the other indices, the Nifty 50 benchmark index, and then relative to the other sectors. And it seems like that the Nifty Auto Index was getting into a bit of a frothy territory when we look at this from the September-October highs for the index. And when we look at these sectoral turnarounds in terms of the ratio charts for many of these indices, that's a process for at least 3 to 4 quarters. So which means what we've seen is just 2 quarters of underperformance from the auto pack, where we've seen the auto stocks, some of them falling by 30-40%. There could be a possibility that this trend would probably get into a drag. The trend for the auto index would be on the downside. I would not be in a hurry to buy this dip.
Okay, that's that on what's happening within autos. But some of the big losers today are also cap codes, infrastructure, telcos, and of course banks as well. But before we take our conversation on the markets forward, let's address an ET Now exclusive. And according to sources, a huge relief is on the cards for OMCs. Now, we understand that Oil Ministry has approached the Finance Ministry for compensation in second supplementary demand for grants for these oil marketing companies. My colleague Prakash Priyadarshi is here with more details on what he's picking up from his sources right now. Prakash?
Yes, an important development coming in as we are learning from our sources that the oil marketing companies are likely to get relief from the government very soon. In fact, we are given to understand that the oil ministry is expecting financial support from the finance ministry in second supplementary demand for grants that will be tabled in the parliament. A very significant development coming in. In fact, the oil ministry has approached the Ministry of Finance once again to compensate oil marketing companies for their losses they are facing on sale of domestic LPG cylinder. In fact, the ministry has approached the finance ministry with some additional inputs and expecting a relief very soon. Sources are also indicating that the government is likely to provide approx rupees 20,000 crore to 25,000 crore to the oil marketing companies to cover their losses they are facing on sale of domestic LPG cylinder. As you are aware, we had reported on December 16, 2024 about the oil ministry's proposal, and now sources are suggesting that the finance ministry is actively considering this proposal and the relief is likely to be provided very soon. And the fact is the oil marketing companies are facing losses of approx rupees 150 on the sale of every domestic LPG cylinder for last several months, and therefore they have approached the government to compensate their losses they are facing on sale of domestic LPG cylinder. The proposal is now being actively considered by the finance ministry, and relief measures could be announced very soon.
Okay, big relief for OMCs coming in the pipeline is what we understand from our exclusive sources. In the meantime, let's welcome on board Devin Choksi as well and find out what he's making of the market right now. Devin, hi, good to have you on the show. Guess the question on everyone's mind is how much more pain to go before we actually see at least a sustained recovery? If not that, at least the selling should abate.
Yeah, Aisha, good afternoon. I believe that I think we are at the tail end of selling in the markets. Maybe I think the larger part of the pain is over. If you see the data of FPI selling from October onwards till date, except couple of months in between, I think now in this month we are likely to see the little lower selling compared to what in previous months we had. Maybe my understanding is that they have actually, I think, already short sold against their portfolio in the F&O market earlier, and currently they are delivering the cash market deliveries and taking the money out. So on one side, I think they have already earned the mark to market by short selling the market, and on the other side, I think now they are picking out the capital. That's what they are doing, and this process is likely to get over sooner than later. Maybe some amount of capitulation is not ruled out, particularly in the crazy valuations of small and mid caps. That could be one of the area, but otherwise in the large cap stocks, particularly in the Nifty 50, where the valuation comfort has also started coming in because of less than 20 times price earning ratio at which they are currently quoting. In my viewpoint, I think the large caps are relatively looking more stable at this point of time. The ceiling pressure over there, I think, has significantly reduced as I see it, compared to, I think, the vulnerable mid cap and small caps, I think, which is continuing to exhibit higher amount of pressure even at this point of time. But that is at the tail end of selling as I see it currently.
Right. Good afternoon, Mr. Choksi. Cheryl also joining in the conversation. And yes, hopefully we are at the tail end of this selling, and I'm sure everyone's really hoping for this one. But I wanted to understand and gauge your take coming in the IT index in particular, because this one today, if you see, you have Tech Mahindra that is seeing a very good run. You have one note which is backing that Tech Mahindra among the large caps will be one of the counters that is likely to see more upside. On the other hand, you have another note coming from JP Morgan, which is actually betting on persistent systems. But what's your take? Which side of the IT should one look at, the large cap space or the mid-tier IT companies?
So importantly, I think having seen the IT companies underperforming in the market for a longer period of time under a variety of threats, a significant amount of short selling has already happened in these counters. And today we are seeing the outcome of short covering, which is basically driving some of the stock prices. And that's exactly likely to happen with some of the broader large cap companies going forward, because market is in oversold territory. Technically, at any point of time, I think when the market is in oversold territory, I think any point of time, I think when the recovery starts happening, the first thing would be the short covering, and that's what I think one can argue for even the broader market also. What one is seeing in IT could happen in the broader market as well. Now, as far as the choice of the company is concerned, certainly the preference remains with some of the mid-tier IT companies where their engineering R&D business prowess is basically helping them in getting significantly large order compared to their size for execution purpose. And they are giving the visibility of 4 to 5 years in respective field in which they are operating. So our take is that engineering R&D space within the IT would be relatively a better choice. The frontline IT companies, they may probably see the larger amount of inflow of orders going forward because of the distinct change happening in the global environment, particularly with the adoption of AI and the computing. In my viewpoint, I think those companies would be on a larger pace, relatively slow to grow compared to the mid-tier IT companies, which are likely to grow relatively healthier pace compared to the others.
Right. Okay, Devin, hold on to that thought. Lots more to talk about with you. For now, we're going to take a very quick break. IT definitely is leading the recovery in the market, but let's see whether the Nifty can pull up further than where we already have.
Welcome back. You're watching Closing Trades and we are coming live to you from the ET Now Motilal Oswal studio. As of now, if you look at the market, steady recovery underway coming in for the benchmark indices. Some interesting comments coming in. Remember that you had the United States and Russia that were meeting in Riyadh, and some comments coming in from Kremlin where they're saying they cannot give an evaluation of the negotiation with the United States officials as yet, but they have only started. They're saying that the main thing is to achieve our aims. They're also saying that Putin has repeatedly said that he is ready to speak about peace. So those are the comments coming in from Kremlin, given the fact that the meeting has just begun. So let's wait and watch out what transpires out of that meeting. But let's put the spotlight more on the markets and how should one actually trade in this sort of a market. And we already have our experts with us, Kunal, Naresh, as well as Mr. Choksi, who are waiting by patiently. Mr. Choksi, let me come to you. And we did speak about the IT index a short while ago before you could join us. I was talking about the auto index and trying to get the technical take on this one, given the fact that it's falling for a 7th consecutive trading session. And also the charts were indicating it was bound to kind of go that way. But fundamentally, for the auto pack, what's your take coming on this one? Because given the fact that yes, we've got the consumption boost, and a lot of commentary is around the fact that people will look to actually upgrade in life, and auto also would be one of it.
Absolutely, and I think selective buying in autos at the corrected valuation is the only answer to this particular observation that you have made. In my viewpoint, I think the fundamentals remains absolutely intact. Consumer demand is also remaining intact. At the same time, government spending significantly large amount of money on building the infrastructure, making it possible for higher amount of commuting for one and everybody. So transportation sector in particular is likely to see the mega growth going forward as well. Leave aside one event of Mahakumbh, in which I think you saw the significant amount of movement in the transportation sector. But in the general condition also, I believe that I think this is going to be growing significantly. So given the choice, the transition is already happening from IC engine to EV. The choice is already happening. Mahindra and Mahindra's advanced booking for 2 vehicles in EV is, I think, a proof of this particular choice that the consumer is exercising. In my viewpoint, I think this is only beginning. Maybe I think the corrected valuations in some of the auto companies and auto ancillary companies, they demand a fresh look for building the portfolio. In some cases, definitely, I think we are seeing more than normal growth coming from now onwards. I think for some of the companies in their working from the fourth quarter onwards and thereafter.
All right, so that's the take coming in on the auto pack. Let me come to you, Naresh, and get your take actually on the entire power space. We had a very interesting discussion today with Bernstein on the entire power space and how this one is looking like. Also, we did speak to Samit Vartak, who said that he would want to play the power theme in the via the power financiers plays. What's your take? Is that the way how to play the entire power space via the power financiers like your REC, PFC, or matter of fact, IREDA?
So the play has been generally been around NTPC Power Grid starting off. Then we saw financiers do well. But I would prefer a basket of both because both of them have corrected similarly. So if you see NTPC, it's corrected from 450 to 300. 300 was the price almost 12 to 14 months back. So the whole excess has been removed. Similarly, if you look at PFC, the stock is at the same price where it was in September, October of 2023. So at 350, 370 PFC and at 280, 300, 310 roughly, NTPC and PFC both look interesting.
Right. In fact, let's actually hear out what Samit Vartak had to say about the entire power theme and the fact how he is ready to play the power space via power financiers.
I am betting it through power finance because then it's more, more diversified. Because whether it's renewable, whether it's nuclear, whether it's, thermal, any kind of power infrastructure which is built, it can fund the distribution network, it can fund the power generators across the board. You will benefit. Whether if you just bet on a specific play like whether it's a wind or solar, it completely depends on the regulations. This is much more safer play where the gross NPAs and the net NPAs will almost be zero. They are writing back a lot of provisions they had taken in the past. They're delivering 20% kind of a return on equity as well as 20% kind of a growth overall, and you're getting these companies at 1.2, 1.3 times kind of a multiple, whereas at the peak in 2012 they were trading at 3.5 times. So reasonably valued. They may have corrected, but these are the opportunities. One has to differentiate between which are the long-term sustainable stories, because India cannot grow without power. So if you are betting on India, you need to find a risk reward plays within power, which will deliver you over the next 3 to 4 years.
Transmission, we are not negative as a theme. We still think transmission is a long-term theme, and that capex numbers which Power Grid has guided on, they should be able to meet. But what we meant is the capex upward revisions, which is what the sector people were playing at for the last year or two, that is more or less done. So Power Grid guiding 35,000-40,000 crores a year capex, that's more or less now understood by the market. We don't expect further upward revisions to happen on that. So that's what we meant by those statements. And thermal also, I mean, while we are again positive on the thermal theme, the challenge is batteries again. Because batteries have become so cheap, they can be a good source of power in the evening hours, which puts into question whether beyond the 80 gigawatts of thermal India has planned, will we be adding further capacity after that.
The headlines 6-8 months ago were that Indian power demand is surging. There is more demand and there could be a shortage. Prices were going unchecked. Suddenly, and if I use your report for reference and other media reports, there is a big slowdown in the new power plant additions and the signing of new PPAs. So what's going on from a situation of desperate addition to no addition? What is happening?
No, good question. See, the biggest driver, as I said again, is power demand. So power demand slowing from 8% to low single digits. That's the key reason why discoms have become a bit more reluctant to sign PPAs. We have seen this before as well. So, and the other reason is we did a lot of renewable tendering in the last couple of years, which the system could not absorb. So combined with low power demand, that is why PPAs are not getting signed. We have seen this in the past. 2019-20 also a similar thing happened. We did a lot of tendering. But when demand picked up in 22, all those PPAs got signed. So this is something I would say a bit cyclical. It should be reversed with time, as our fundamental belief is still that 1x of real GDP should be a base case assumption for power demand. 6 months here, 6 months there, but our medium-term outlook is still the same in terms of power demand. And as to power shortage, even if you look at the spot power prices today, it's still 10 rupees in the evening hours of the day, in the morning hours. So essentially, the non-solar are a problem that is still there in India. It's not gone so much. Renewable is where you've seen a slowdown in PPA signing as demand has softened and a large quantum got tendered.
But logically, some would say that renewable demand or renewable PPA should only go higher because that's where the government push seems to be, that's where the government drive seems to be, and also the way renewable prices are coming down now from about 9 rupees a unit to about 3 rupees a unit. Isn't that a no-go?
So what is happening on the renewable, we have to realize it's not as if, PPA slowdown has happened, but it's not like construction has slowed down. So we are still adding 30 gigawatts of renewable a year, which is a huge number. So 30 gigawatts of renewable is a capex of almost 2 lakh crores.
Okay, that's all you wanted to know about how to approach the power sector right now. But Devin, what one has keenly observed is that in the recent correction, the first signs of the dip actually came by within the entire PSU pack. That, of course, it was one space where you had concentrated gains. But the selling there persists. Even as I look at it today, likes of BEL, NBCC, BHEL, HAL, they're still seeing selling. Are there any pockets within the entire PSU basket where you think the correction is now overdone and one can start nibbling in?
Aisha, I think the trouble lies with the weaker hands. I think those who have entered into this particular stock without understanding what these companies could deliver, they are the ones who are exiting this company with a panic in these counters. We have been repeatedly saying that some of the PSU companies are excellent businesses. However, I think the growth that they can produce is going to be always limited or in parity with the growth in the economy, that is GDP. So, frankly, I think when one is giving the higher valuations to this company, certainly it is discounting far more in advance about the prospects of those companies, which otherwise remain stronger because of government spending on infrastructure, among others. Having said that, I think some of these companies have had a sharp correction by now, and the prices have become slightly more affordable compared to what they were before. Not completely sure whether I'll put my 100% bet on them immediately because of the fact that I think the weaker hands are still holding the stock. And in any subsequent rally due to recovery in the market, they would be the ones I think would be coming up front and probably sell some of the stocks. That's where I think one would like to play a little bit more cautious. Maybe some panic selling on some day in some of the counters could be buying opportunity, at least I think for recovery in the shorter duration thereafter.
It's been so good having you on the show. Thanks as always for your time.
Thank you.
Okay, let's get in some closing ideas as well before we take that break and continue tracking markets and the last half an hour of trade. Kunal, what's looking good to trade right now?
So I'll go with the band Wipro. That's a chart and a stock which has bounced back from its 50-day moving average just around the 305 mark, and also on the candlestick front, it's forming a potential bullish engulfing pattern. So on the back of it, would be bullish on Wipro, at least from a near-term play.
Right. Naresh, what about your closing ideas?
So looking at a bounce back on NTPC, the stock had made a bottom around 295, 300 back in January, a month back. In the last 2 days, reversed from the same area. So expecting a bounce back towards 320, 330.
Okay, let's take a very quick break. The recovery holds on. Whether we can push it into the green any further than this recovery, we'll continue tracking that on the other side.
You want to watch
NTPC, that's your large cap winner today, 2.5% higher on that stock. And other than that, a lot of these technology plays are the ones which are holding up well. So Wipro holding up a solid 2%. TechM is looking very smart in trade. Other than that, look at the moves coming in on a persistent, holding up 4%. There's LTIM, which is looking very strong, a good 3% move coming in there. And then some of the other ancillaries like a Naukri as well, holding up 2.5% as we speak. Sona Comstar definitely seeing the Tesla effect rub off on it. A 4% move is what Sona Comstar, or BLW actually, is currently sitting on as we speak right now. But in the recent market correction, let's also take a look at how much the ongoing correction has dampened the portfolios of some of the ace investors. Jinay from our research desk joins in, and he's been tracking some of these portfolios very closely. Jinay, tell us who lost how much?
Well, definitely. If you look at the amongst the prominent investors, the one name that clearly gets highlighted is Radhakrishnan Damani. If you look at the overall change in the portfolio, the holding value, current holding value as against of Q4 holding value, it's a net positive change of 2.5%. Current holding value stands at 1.67 lakh crores. And the top stock holdings of Radhakrishnan Damani is Avenue Supermarts, Trent, and VST Industries. Apart from that, if you look at Rakesh Jhunjhunwala family's overall portfolio, they have seen the holding has seen a cut of about 12.4% in the current value against Q4 value, and the top stock holdings there stays as Titan and Concord. Apart from others, overall again Akash Bansali seen a cut of 18.3%, Mukul Agarwal seeing a cut of about 14.4%, and Nimisha also seeing a cut of about 17.6%. The top picks of Nimisha is LMW Asahi and LG Equipments. Apart from this, if you look at the biggest cut, it's Vijay Kedia, about 22% cut in the holding of Vijay Kedia. It stands at around 1,150 crores as of now versus the holding period in Q4 of about 1.47 K crores. And the top picks of Mr. Vijay Kedia is Atul Auto, Tejas Networks, and Newland Laboratories. Apart from this prominent investors, if you look at others, Hemendra Kothari also seen a cut of about 11.2%, and Ashish Dhawan there's also a cut of about 12.3%, but the top holdings are Glenmark, Pharma, IDFC First Bank, and Quest Corp.
All right, so those are the top holdings of ACE investors and who's lost how much in this sort of a correction in the markets. But now we also have Ashi Anand, who is the founder and CEO at IME Capital, joining us on the show to talk about markets and the way forward. Hi, good afternoon to you, Ashi. Thank you so much for joining us in ET Now. And the key question that we are asking all of our participants is the fact that how much more of a selling are we likely to see, or do you think that the end is near now?
Hi, good afternoon. Firstly, thanks so much for having me on the show. So that's really the question on everyone's mind, right? We don't necessarily think we are at the absolute bottom. There could potentially be further downsides. And just to kind of understand that in the overall context, right? Markets have kind of doubled from before pre-COVID levels, right? Not taking the COVID fall. But if you look at the large cap indices, they have doubled from pre-COVID. You're down only 10%. Small caps are up 300%. You're down only about 20%. If you look at the kind of corrections in the context of the immediate move that you've seen on these broader indices, the correction is really not something which is very sharp. Now, if we look into what are the factors driving this current correction, right? You've got a slowdown in both economic growth and clearly in corporate earnings. We've just completed the kind of corporate earnings season. You've had a low single-digit kind of earnings growth for the Nifty. You also kind of have a combination of other factors. You have interest rates where the whole interest rate reduction cycle is actually getting delayed. You have uncertainties related to what Trump is doing, especially in terms of trade and tariffs, and also a generally weak rupee. Now, in the context of the fact that there are multiple headwinds to the markets, markets have moved up substantially over the last few years. And the correction is still something which is not something which is very steep in the context of the kind of larger move. We wouldn't be surprised if you could see further downsides to the market. The only thing is, given the very strong strength of the longer term India story, we don't believe you'd see substantial downsides. We are a bit more concerned about small caps. So broadly, if you're just looking at it, I think on the larger cap indices, another 5-10%, and that should pretty much be done. But what we are concerned about is small caps. Because in small caps, if at some point in time the retail investor starts panicking, liquidity can dry up very rapidly, right? And you could see very sharp downsides there. So it is a market where we would advise investors to kind of remain cautious.
Okay, interesting. Ashi wanted to understand whether there are any value zones now, pockets which may have corrected significantly where you think one can start buying into.
So clearly, right, there clearly are quite a few interesting value zones. I'll just give you some of the kind of areas that we are kind of focusing on. Digital is it's a space we've spoken about multiple times in the past. We really see a lot of value in terms of the longer term growth potential of listed digital platforms, both in terms of the ability to scale up not just revenues, but also increase profitability. A number of these counters have actually fallen quite significantly. This is something that it is very important that any investor looking at the space needs to take a properly long-term view, right? We're talking about 3 to 5 years plus. But for anyone with that kind of a time horizon, we're seeing a lot of attractive opportunities in digital. Within BFSI, I think there are a number of banks ranging from some of the high quality franchises that haven't been performing, or certain other banks with higher exposures to unsecured or MFI, which have corrected very significantly. Some of these do present some quite attractive buying opportunities. So, on that second bucket, in terms of the banks with the MFI unsecured exposure, you probably just want to wait for the dust to settle. Apart from that, there are certain kind of sectors where there is very, very strong business momentum and a very strong longer term kind of story. So these would be kind of companies in capital markets and real estate and capital goods. All of these had run up very considerably. These are also kind of stocks that have led the fall. So they've all kind of fallen more than the kind of overall markets. However, given how sharp the move is, we kind of believe that there could still be some amount of time before these become attractive buying opportunities. But in the context of the longer term growth, for people with a slightly longer term horizon, I think some attractive buying opportunities in these spaces could also emerge.
So some attractive opportunity in the space, especially when you talk about the cap goods space, could emerge. And taking that question forward to you, Kunal. So in the cap goods space, which one looks good to you? But because this particular sector also has not been spared in this sort of a correction.
Yeah, it's not been, and I think many of these stocks, they're down some 30-40%. So, whether you look at L&T, you look at ABB, etc., many of these stocks from their September or 2024 highs, to put it broadly, I think these stocks have fallen by 40%. And these are very rare kind of corrective phases for these stocks, because when stocks like L&T, etc., when they fall 40-50% in a span of 6-8 months, that's generally considered to be a very good opportunity to try and look at it from a long-term play. Now, historically also, when we looked at the charts over the last decade and a half for many of these names, there have been many phases when these stocks have corrected by 30-40%. And that's generally been par for course, where these stocks come back into good value territories. In some zones, there were points where the stocks have come back into deep oversold territories. So I think we are somewhere in the midst of that kind of a price territory for many of these cap good names. I think buying on a staggered approach at current levels could be a good strategy. And whenever these stocks show the first potential signs of a turnaround, that's where I think one should look to even start allocating a higher allocation of capital.
Okay, that's that on cap goods when it comes to a space. Technology, of course, is the one space which is looking quite good. Ashi, you were just talking about, some spots within the new age tech space. But what about traditional IT services? How does that look in the time of, not just AI, but all that's happening in the US as well?
So IT services definitely does look interesting. You kind of need to bifurcate a bit between a shorter term and a slightly longer term outlook. In terms of the shorter term outlook, there are a number of kind of positives that you are seeing in the space. Firstly, just as in it's one space where the weakness in the rupee clearly does help these companies, right? So weakness in the rupee is clearly positive for margins. So that is one thing. The second core is really there is a large amount of optimism around how Trump could potentially kind of revive the US economy. Now, that is something which will clearly help IT companies. They have all been kind of struggling with weak discretionary demand. We all know these are amongst the highest quality companies in India, not just in terms of corporate governance, but if you look at their financials, you look at the balance sheets, you look at financial ratios, etc. These are very high quality companies that are still available at fairly attractive valuations. Growth has been a concern with the US economy potentially turning around. And with kind of the rupee weakness, you have support in terms of both revenue and margins. AI is going to be a very, very interesting thing to watch. The way we look at kind of the impact of AI on IT services is in the near term, it's actually likely to be a boost. There will be tremendous amount of productivity benefits that IT service companies would be able to kind of extract through the appropriate use of AI. And a number of enterprises will also be looking at kind of adopting generative AI into their business models, and they will need IT firms to help them with that particular transition. It's more from a slightly longer term perspective as AI becomes that much better at coding. that you'd actually have AI possibly being able to replace a certain amount of your coding talent. Now, while this is technically positive at some level for an IT company, right, because you are reducing resource requirements in terms of number of resources, and it's also technically positive for margins, but it could very clearly lead to a deflationary environment over the longer term. So IT services is a space that clearly looks very attractive, looks fairly attractive from a 1 to 3 year perspective. But I think longer term, the impact of AI is something that does need to be closely monitored.
The IT pack for you, which looks good. Apart from IT, then if I will have to ask you about pharma as well, because a similar sort of story playing out if you have to talk about what's happening in the United States, about tariffs, the fact that last week you saw this entire sector actually bear the brunt of the fact that what will happen when you talk about the tariffs or the reciprocal tariffs on the pharma space. Yesterday was pretty okay for this particular sector. Today they are holding on with loss of about 0.5% or so. But what's your take on the pharma sector? Do you think the pain is over, or the sort of negative news flow around the tariffs may be overdone, and it's time to look at the space given the fact that the positives outweigh the negatives?
So when it comes to pharma and tariffs, right, there is a general kind of hope in the markets that pharma would actually be spared. And the biggest reason for the same is that there are very large number of drugs that are still in kind of shortage in the US. A move towards genericization and lower quality, lower price drugs is a very clear requirement in the US. So actually putting on tariffs which should actually increase the cost of drugs is clearly not something that may be a very smart move from a political perspective. So there is some kind of hope that pharma may be spared from very aggressive tariffs. You are also trying to, as part of the Biosecure Act, you are trying to shift production away from China towards other economies. So even if some form of tariffs do come in, we kind of believe that it may be a little more targeted at China. But a lot of this we really have to sit and watch. This will increase uncertainty in the near term, but the kind of hope is that tariffs in the pharma sector specifically may not be that high. However, when it comes to pharma, one important thing to kind of just understand is that there's been one very large drug called Revlimid, which has boosted earnings for a very large number of companies. Now, as the revenues from this particular drug plateaus, it does create a fairly high base for companies to grow off. And therefore, when you're looking at pharma, it's very important to go in stock specific, look at the specific pipeline of new drugs that are kind of going to come in to be able to take care of this high base that Revlimid kind of creates. And therefore, we believe that in pharma, there is the potential for certain earnings downgrades in companies that don't have a strong enough near-term pipeline. And investors just need to be careful about that element.
All right, so that's the take coming in on pharma when you talk about the fact that what's happening to it fundamentally, how you should actually gauge this entire space. But Naresh, on the charts, a couple of pharma names saw good up move in yesterday's trading session. Case in point being Piramal Pharma, 8% up move in yesterday's trading session. Let's take a look at where Piramal Pharma is in today's trading session. Given the fact that this one has been actually seeing healthy buying of late, 1% downtick coming in for Piramal in today's trading session. But on the charts, which pharma company is looking really good and poised to make a good comeback? And when it makes a comeback, it will be a solid one.
So, for example, if you look at Piramal Pharma, the stock has corrected 40% all from the top. So bounce back is in play. Names which look very strong is something like a Cipla, which has been sideways for the last 6-8 months. Currently also holding up. Same is the case with the Sun Pharma, which has consolidated well, or a DV's Lab. So the whole large cap pharma looks very interesting as a defensive bet.
Large cap pharma and the take coming in there. Just looking at some of the other names, right now. For Persistent, of course, which is a big winner today, there's a JP Morgan note which has come in wherein they've upgraded the stock and maintained their overweight on the stock price with the target price of 7,200, and that indicates a significant upside to the current market price. They're saying that this dip currently that you're seeing, it's a high quality growth compounder describing Persistent. They're saying it's offering a good 30% upside potential from the current levels. They're saying they came up with a new target of $5 billion revenues by FY31, which is implying a very strong 26% CAGR growth over FY27 to 31. That's that on Persistent, of course. That's holding up well. Let's see what OMCs are up to. Remember, we just reported to you exclusively a short while back that perhaps OMCs are likely to get some relief and that the oil ministry is expecting some amount of financial support for OMCs in the second supplementary demand for grants for FY25. OMCs will just come up for you on your screens next. My colleague Prakash just reported that exclusive story, and those stock prices will be up on your screens next. Other than that, we're just looking at ABB, for instance. That stock, of course, is down quite a fair bit from its all-time highs. It's a very cautious note that they have actually talked about, or tone rather, in their conference call. They've talked about as to how the market is stabilizing. The PAT range, margin range will be about 12 to 15%, and currently it was at about almost 15.8. They're saying while they did enjoy better pricing environment in 2024, but yeah, the valuations are most expensive amongst the peers, so that really is not auguring well for ABB as we speak right now. That said, some of the other names like Sona Comstar, Phoenix, Naukri, etc. are the ones which are definitely holding out. There's a Berger Paints which has stacked up almost about 1.5% as we speak right now. Bata down about almost 1% right now. But let's see which way some of these consumption names actually head. Ashi, I wanted to understand what your thoughts are on consumption. I know you don't track it perhaps as closely as the IT and the tech pack, but any of the consumer names, not just staples, but the entire range, anything that's looking interesting after the recent sell-off to you?
No, and we definitely do track consumer very closely. We run a tech fund, but we also run a general flexi cap fund, and consumer is an important kind of weight there. I think consumer is basically a segment where you are kind of weighting the kind of overall growth recovery. There are certain, the important part is in the current kind of results season, you have seen certain mixed trends, and there have been certain companies that have actually outperformed on overall growth. However, consumer is not it's not all segments of consumer that are kind of firing. So I think in the current kind of environment where you are kind of waiting to see an overall consumer recovery, you do need to be quite picky about the specific companies that are being able to grow even in this current environment. We've got investments in Titan, which has consistently been doing very well, and they've continued to perform in the current quarter. You have seen other packs, right? So we do have Nykaa in a digital portfolio that has done fairly well. Britannia is the one, Britannia and ITC within kind of the FMCG pack are the two FMCG companies that we hold along with Jyoti. So those are the three. All of these either are very attractive from a valuation perspective. So both in ITC and Jyoti trade at substantial discount to their peers. And Britannia has actually been holding up quite well in terms of overall growth. They have a very interesting transition towards becoming a packaged foods business, a larger packaged foods business. Very interesting kind of initiatives they're taking in the Hindi heartland to actually be able to grow larger in the space. So consumer clearly is an attractive space. You just have to be kind of careful about the segments you're going into. We do prefer discretionary consumer over non-discretionary or FMCG over the longer term. But that pack is currently a bit weak on growth. As overall urban consumption comes back, we actually see a lot of interesting names out there.
Kunal, what's your observation on charts? Britannia, how's that looking?
Yeah, I think Britannia, HUL was one of the few ones which has actually formed a bottom for itself, at least on the very short-term charts. The stock had stopped falling. Britannia, on the other hand, the stock had seen a rise. I think the all-time highs for the stock was around 6,400 levels, fell down to as much as 4,600, 4,680, and then bounced back again to 5,200 to 50 mark. And now it's back again to sub 5,000 levels, which means that the stock is establishing a range around the 4,600 as a support and 5,200 as a resistance. Maybe I think if the stock gets into a second retest towards the breakout on the upside, just about that 5,000 plus mark, that could be a point where would be encouraged to buy the stock.
Okay, that's that on Britannia and how the charts for that and Unilever are looking. The other stock I want to bring up is also Max Healthcare. UBS has come out with a note on Max and they're upgrading the stock to now a buy from the earlier neutral. They've upped the target price also, doubled it in fact from 610 to now 1200. They're saying that the stock is down almost 13% in the past 2 weeks alone and is throwing up an attractive entry point. Ashi, what within the entire healthcare space and not just hospitals but diagnostics as well, I'm going to throw in here, what's looking interesting to you?
So within kind of healthcare, right, we prefer hospitals to diagnostics. I know in the recent past, diagnostics has also been doing reasonably well. But the reason we kind of do prefer hospitals, even though it clearly is a much more capital intensive business, is that hospitals tend to have a much stronger competitive moat. One would argue that hospitals are much harder to disrupt. What you are kind of seeing in the diagnostic space is there are a number of new kind of entrants coming in. The barriers to entry for someone to enter diagnostics is really not that significant. There have been multiple notes in the past that have really spoken about the very wide price differentials that exist between different diagnostic players. So while diagnostics is clearly a very strong growth opportunity, we kind of believe that there's clear competitive threats, and kind of competitive threats have kind of come in and waned. There was very significant pricing pressure a year back that has since reduced, but it is something that we believe could kind of come back. We also believe that there is clear scope for a smart new age digital first kind of tech disruption in the diagnostic space, and how that will play out in terms of pricing and margins, etc., in diagnostics is something we have been a bit watchful for, and this is why it's largely been a space we've stayed away from. Hospitals, on the other hand, there clearly is underpenetration of hospitals in India as affordability improves because of kind of greater insurance availability, right? Ailments are clearly on the rise. Awareness in terms of treatments are clearly on the rise. You do have a kind of a fairly interesting growth runway where occupancies and ARPUs can both kind of move up. That said, when you look at hospitals, you really need to be careful about what stage of a capex cycle hospitals are in, because whenever they go in through a strong or aggressive capex phase, a new hospital takes about 3 to 5 years to actually break even and start making money. What we've seen in the past is when there is a very aggressive capex phase, these companies don't really perform very well. So we prefer hospitals over diagnostics, and within hospitals, we prefer kind of companies that aren't going through a very aggressive capex in the immediate near term.
Hospitals, when you compare it with diagnostics, that's what Ashi actually prefers. On that note, thank you so much, Ashi, for joining us on the show and giving us your take on the markets, as well as talking about a lot of sectors and which look attractive at this point in time. Coming back to you, Kunal, let me take your BTST ideas for our viewers.
So yeah, there will be two buy calls. The first one is one ONGC, and after quite some time, we are seeing the stock, showing 2 consecutive days of steady price uptrend. So would look out for targets in the range of 244. Stop loss could be kept at 229. And the second would be about Ashok Leyland, something which I discussed in the morning, even on the chart busters, that the stock is heading towards a breakout, potentially above its 200 DMA, as well as a price volume breakout about 220 plus levels. So targets of 230, stop loss at 214.
Naresh, what about your BTST ideas?
So first would be a buy on NTPC, a good recovery from the lows. Revised stop loss at 309, target price of 315. Second would be a buy on HDFC Bank, which has been holding on through the whole day. Expect some more move up here. Stop loss at 1720, target price of 1755.
Okay, Kunal, Naresh, we'll leave it at that. In fact, on that note, I'm going to hand it over to Snehi as well for the closing trades.
Well, absolutely. Let's take a look at how today's trading session has panned out, and we've seen some amount of recovery coming in on the Nifty 50 from the day's lowest point. It's an uptick of roughly 130 points from the day's lowest point. Nonetheless, we're slightly in the red when you take a look at how we're closing for the day. A 0.1% cut coming in on the Nifty 50, 22,930. At least we seem to be ending above the 22,900 level, because at one point in the trading day, it seemed to be difficult for us to hold on to the 22,800 levels as well. Nonetheless, it's been a recovery of 130 points from the day's lowest point, so looking decent for the Nifty today. Sensex, however, has recovered some of those lost points, but still continues to trade under the 76,000 mark. And you have Sensex that's ending rather flat with a very slight negative bias coming in across the board. Nifty Bank also 0.4% cut coming in, and that index has not done much today, but is barely holding on to the 49,000 level as of now. Advanced decline ratio is steeply in the favor of the declines today. On the back of that, initially in the first half of the trading session, we did see a 3% spike coming up in India Wix. However, that has cooled off completely, and India Wix is looking good right now because last we saw India Wix was in the red. Yeah, well, 3% cool off coming in. We're comfortably below that 16 mark that we had crossed in the first half of the trading session. Broader markets merit a special shout out today because deeper cuts of red being seen on the broader markets. Nifty mid cap is lower by 0.4%, but it was the small cap index that was taking it rather on the chin in today's trading session. More than a 1% cut, or rather, in fact, it's tilting towards a 2% cut coming in on the Nifty small cap. So the small caps have taken it on the chin in today's trading session. Well, that was the market construct for today. Let's take a look at some sectoral gainers and losers, and in fact a few names only on the gaining side. Nifty IT throughout outperformer in today's trading session, 0.8% after coming in on Nifty IT. The likes of Persistent Systems, you had Newsflow, you had a brokerage note over there. LTI Mindtree also was in focus today on the back of that partnership that they've done with Greece's Eurobank. Tech Mahindra, next big winner in the IT pack on the back of that CLSA note wherein they've given the target 2030 and maintained their outperform. All of these were very solid winners in today's trade. Wipro, L&T, HCL Tech, Infosys, Coforge, all of these IT names have ended the day in the red, on the back of which IT was your biggest sectoral gainer. That was followed by Nifty Energy, and surprisingly Realty has managed to tip over to the green. That's a surprising sector given all the pressure that we've seen around the real estate pack over the last couple of months. Nonetheless, on the flip side, Nifty FMCG sharpened its cuts and was the biggest sectoral loser on the trade today. Almost a % cut coming in on the entire Nifty FMCG index. That was followed by Nifty Media, Auto, Pharma, PSU banks and metals. That's your pecking order from the most to least losers in today's trading session. Bharti Airtel was a stock to talk about on the back of its the block deal that we saw, wherein Indian Continent Investment, which is the founder-controlled firm, sold 51.1 million shares. So Bharti Airtel was in focus. Almost a 0.4% cut coming in on that front as well. Star Cement, Karnataka Bank. You had a lot of other stocks. ABB India, of course, on the back of its good earnings, but that stock reversed completely in today's trading session and fell deeply into the green. Cuts of 2%. So some recovery seen over there because it was 6% lower, but some recovery on that front. It's a 2% cut coming in on ABB. These were some stocks that we wish to highlight today, but nonetheless, this is how we're wrapping up for the day. Nifty around the 22,920 mark. Only a slight bit of shade of red coming in across the Nifty for today's trading session.
If you like this video, then like, share and subscribe to ET Now.